Ladies and gentlemen, I want you to imagine something with me for a second. Picture the most crowded trade in financial history, every hedge fund, every retail investor, every pension manager piling into the same stock at the same time, convinced they found the one company that will ride the biggest technological wave since the internet itself. Now imagine being the person who walks away from that trade at the exact moment everyone else is doubling down. That's what I just did. I sold my entire Nvidia position last week, and I used that money to buy Walmart. Yes, Walmart, the company your grandmother shops at for discount groceries and paper towels. And before you click away thinking I've lost my mind, before you dismiss this as clickbait from someone who doesn't understand what's happening in artificial intelligence, I need you to hear what I'm about to tell you. Because there's a pattern emerging right now, a pattern I've seen destroy trillions of dollars before, and almost nobody in the finance world is willing to say it out loud. They're afraid of looking stupid. They're afraid of missing out. But I'm more afraid of what happens when this pattern completes itself. What I'm about to share with you isn't about whether AI is real or transformative. It absolutely is. This is about something far more dangerous. It's about the gap between technological promise and economic reality, and that gap is about to swallow a generation of investors whole. Let me be direct with you. If you're watching this video right now, you're either already invested in Nvidia, you're thinking about getting in, or you're desperately trying to figure out if you've already missed the boat. What you're really looking for is someone who will tell you the truth without the financial media spin, without the vested interest, without the fear of being wrong. That's exactly why you need to subscribe to this channel right now and turn on notifications. Because what we do here is different. We don't chase narratives. We don't worship stocks. We follow the money when it moves, not when everyone's already talking about where it went. The analysis you're about to hear isn't available on CNBC. It's not being discussed in your brokerage's research reports. It's the kind of pattern recognition that separates people who preserve capital from people who learn expensive lessons. So hit that subscribe button, because in the next market cycle, you're going to want early warning intelligence, not late-stage confirmation bias. Now, let me take you back to understand how we got here. Nvidia has been nothing short of a miracle stock. In 2023, it became the poster child for the AI revolution. The stock went from roughly $140 to over $400 in a matter of months. Jensen Huang, the CEO in his signature leather jacket, became a rock star in financial circles. Data centers were buying graphics processing units like they were going out of style. Every earnings call was a blowout. Every guidance raise was met with another surge in the stock price. The narrative was perfect, and it was simple. AI needs compute power. Nvidia makes the best chips for AI compute. Therefore, Nvidia equals AI equals infinite growth. Wall Street loves simple narratives. Retail investors love simple narratives. And for a while, that narrative printed money. But here's what they don't teach you in business school. The best time to sell a stock isn't when the story breaks. It's not even when the stock doubles. The best time to sell is when the story becomes so universally accepted that questioning it makes you look insane. When your Uber driver is talking about AI chip shortages. When every financial podcast has the same guest saying the same thing about the same company. That's not the beginning of a trend. That's the end of it. And we are deep, deep into the end phase right now. Let me walk you through something that's bothering me, something that should bother you too. Nvidia's customers, the hyperscalers, the Microsofts, the Googles, the Amazons, the Metas of the world, they've been spending money like drunken sailors. Capital expenditures across these companies have exploded. We're talking about hundreds of billions of dollars being poured into AI infrastructure. Microsoft alone is projecting capex of $80 billion this year. That's more than most countries spend on their entire military budgets. And where's that money going? Predominantly to Nvidia. So far, so good, right? Record revenue, record margins, record everything. But now ask yourself a different question. What are these companies getting back for that spend? Because here's the uncomfortable truth that's starting to emerge in earnings calls if you listen carefully. The return on investment for AI infrastructure is becoming harder and harder to articulate. Meta spent tens of billions building out AI capabilities. Their stock got crushed when investors started asking what the actual business model was. Microsoft is embedding AI into everything, but enterprise adoption is slower than expected, and customers are hesitant to pay premium prices for features they don't fully understand yet. Google is in an arms race with itself, terrified of being disrupted, spending billions on AI that's cannibalizing its own search business. Amazon's AI ambitions are real, but they're also facing the reality that building models is expensive and monetizing them at scale is even harder. What we're witnessing is a classic capital cycle boom. And every single capital cycle boom in history ends the same way. Overcapacity, falling returns, pricing pressure, margin compression. It happened in fiber optics in the late 90s. It happened in shale oil in the 2010s. It happened in solar panel manufacturing. It's happening right now in AI infrastructure, and the market is pretending it isn't. Here's the part that keeps me up at night. Nvidia's entire valuation is predicated on the assumption that hyperscaler spending continues at this pace or accelerates. But we're already seeing cracks. In recent earnings calls, multiple hyperscalers have signaled that they're becoming more disciplined about AI spend. They're talking about optimizing workloads, improving efficiency, evaluating return on investment more carefully. That's corporate speak, for we can't keep lighting money on fire forever. And the moment that spending slows, even slightly, Nvidia's growth story implodes. Not because the company did anything wrong, but because the expectations embedded in a stock trading at 40 times earnings require perfection. They require acceleration. They require a world where AI spending never stops growing at exponential rates. And then there's the competition angle that nobody wants to talk about, honestly. Nvidia has dominated AI chips because they were first, because they built an ecosystem, because CUDA became the standard. But monopolies in technology don't last. They never do. AMD is coming after them aggressively with competitive products at better prices. More importantly, every single hyperscaler is building their own custom chips. Google has TPUs, Amazon has Trainium and Inferentia. Microsoft is developing its own silicon. Meta is working on custom AI accelerators. These companies are spending billions to reduce their dependence on Nvidia, and it's working. We're already seeing signs that Nvidia's pricing power is eroding. The gross margins that looked untouchable a year ago are starting to face pressure, and once margin compression begins in a semiconductor cycle, it accelerates fast. Let's talk about something even more fundamental: valuation. I know valuation sounds boring. I know the standard response is that you can't value a transformational technology company on traditional metrics. I've heard it all before. But here's the thing about valuation. It doesn't matter until it does. And when it matters violently. Nvidia is trading at a valuation that assumes it will grow earnings at 30% annually for the next decade, while maintaining best-in-class margins, while facing no meaningful competition, while customer spending never slows. That's not a bull case. That's a fairy tale. The moment any one of those assumptions breaks, and I just outlined why several are already breaking, the stock doesn't drift lower. It gaps down, hard. Now contrast that with where I moved my capital. Walmart. I can already hear the objections. Walmart is boring. Walmart doesn't grow. Walmart is for boomers who don't understand technology. Let me tell you what Walmart actually is right now. Walmart is a cash-generating machine trading at 18 times earnings with a 2% dividend yield that grows every single year. Walmart has pricing power in an inflationary environment because they're the low-cost provider. Walmart is taking market share in e-commerce from Amazon. Walmart's advertising business is growing at 40% annually, and barely anyone is paying attention. Walmart has a fortress balance sheet and generates $30 billion in free cash flow every year. But here's the real reason I rotated into Walmart, and this is what you need to understand about market cycles. Late cycle environments favor companies that don't need the story to work out perfectly. They favor companies that print cash, regardless of what happens to interest rates or economic growth or technological narratives. In early cycle bull markets, you want exposure to high growth, high multiple, story-driven stocks. In late cycle markets, especially when valuations are stretched and economic uncertainty is rising, you want the exact opposite. You want boring, profitable, defensive businesses that will still be standing when the cycle turns. And make no mistake, we are late cycle. The yield curve has been inverted. Credit spreads are widening. Small cap stocks are underperforming. Retail sentiment is euphoric. Insider selling is at multi-year highs. These are not early warning signs. These are flashing red lights. The financial media won't tell you this because bearish content doesn't generate clicks, and their advertisers don't want you getting defensive. But every major market correction in history was preceded by exactly this setup. A narrow leadership rally driven by a handful of mega-cap stocks while breadth deteriorates underneath. A transformational technology narrative that justifies any valuation. Universal bullish sentiment, and positioning so crowded that any shock to the system creates forced selling that feeds on itself. Think back to every major bubble you've studied. The dot-com crash, the housing crisis, the COVID growth stock implosion of 2022. They all followed the same script, a real technological or economic shift. Legitimate early winners, capital flooding into the space, valuations detaching from fundamentals, universal acceptance of the narrative, and then a catalyst, often something small, that breaks the spell. It doesn't matter if the underlying technology was real. The internet was real, and it still didn't save pets.com. Housing was a real asset class, and it still didn't save Lehman Brothers. AI is absolutely real and transformative, and it still won't save investors who bought Nvidia at nosebleed valuations during peak euphoria. Here's what I think happens next, and I want to be clear that this is probabilistic thinking, not a prediction. I think hyperscaler capex growth slows over the next 2 quarters as CFOs start demanding better returns on AI investments. I think Nvidia reports earnings that beat expectations but guide conservatively, and the stock sells off hard because it's priced for perfection. I think we see accelerating competition in AI chips that pressures both market share and margins. I think multiple compression happens fast as investors rotate from growth to quality. And I think the broader market, which has been held up by 7 stocks, starts to crack as the AI narrative loses its magic. When that happens, where do you want your capital? Do you want it in a stock that needs everything to go right just to justify its current price? Or do you want it in a company that generates predictable cash flow, has pricing power, pays a growing dividend, and trades at a reasonable valuation? This isn't about being bearish on technology. This isn't about being a Luddite who doesn't believe in AI. This is about understanding market structure, capital flows, and the difference between a great technology and a great investment at any price. Walmart isn't exciting. It won't triple in a year. It won't make you feel like a genius at cocktail parties, but it also won't cut your portfolio in half when the narrative breaks. And in late cycle markets, not losing money is how you win. The investors who preserve capital during drawdowns are the ones who have dry powder to deploy when genuine opportunities emerge. The investors who stay fully invested in crowded momentum trades are the ones who spend the next 3 years trying to break even. I want to leave you with one final thought, and this is the part that should really make you uncomfortable. Every single person telling you to buy Nvidia right now has a vested interest in you believing the story. The analysts who cover it work for banks that do business with Nvidia. The fund managers who own it need you to buy it so their positions appreciate. The financial media needs you engaged and clicking, and nothing drives engagement like a rocket ship stock. The only person in this equation without a vested interest in the narrative is you, and the only person who will suffer the consequences if it falls apart is also you. So ask yourself, honestly, are you buying Nvidia because you've done deep fundamental analysis on semiconductor cycle dynamics, hyperscaler capex trends, competitive moat durability, and valuation sensitivity? Or are you buying it because it's gone up, because everyone says AI is the future, because you don't want to miss out, and because it feels like the safe consensus trade? If it's the latter, you're not investing. You're gambling. And you're gambling at exactly the point in the cycle where the odds have shifted against you. My rotation from Nvidia into Walmart isn't a prediction that Nvidia goes to zero. It's not even a prediction that Nvidia underperforms next month or next quarter. It's a recognition that risk and reward are no longer in my favor, that the crowd is all leaning the same direction, and that preservation of capital matters more than participation in the last leg of a momentum trade. Walmart is my way of saying I'd rather miss the last 20% of an upside move than experience the first 50% of a downside move. The market has a way of humbling people who confuse a bull market with genius. It has a way of punishing people who ignore valuation because the story is compelling. And it has a way of rewarding people who have the discipline to walk away from the party before the lights come on. I've made my choice. The question is, what choice are you going to make? Because I promise you, 6 months from now, one of us is going to look very smart, and the other is going to have an expensive lesson to reflect on. I'm betting on boring, I'm betting on cash flow, I'm betting on defense, and I'm sleeping better at night because of it.